Cool. Okay, so if everyone can hear me, thanks for joining us at the TCD Geography Department Lunchtime Seminar Series, and this is the final seminar of 2021. And as you just heard, it is being recorded, so please be aware. We'd ask to keep your microphones muted, and it's your decision for your video. But yeah, so I'm Tommy Gavin. I'm a PhD candidate here in the department as an urban geographer. Myself, Rory Rowan, and Maeve Neil-Aughlin have been building on the great work done in the previous academic year by Rory, Kathleen Stokes, and Stefan Hugel. And we feel this is quite an important space to come together as a department and as a community of geographers, not least in these persistently disruptive circumstances. But today we're very excited to welcome Dr. Zsuzsanna Pósfai, who recently joined the GeoFin team as a research fellow. GeoFin is a 5-year project examining the way in which Western banks penetrated Eastern Europe following the collapse of communism and how new geographies of financialization have been created in the process. Dr. Pósfai has been engaged in the field of housing and housing policy for over 10 years, with experience of housing policy at a local administrative scale in Hungary and France, and in housing activism as well as academia. And so in recent years, her research has focused on the mechanisms of investment in the housing market and over indebtedness in households. So today, she'll be discussing first what effects the Hungarian government's post-crisis measures have had on housing finance, which is namely an entrenchment of housing market inequalities and a new house price bubble. And then secondly, what new financial mechanisms will be needed for more accessible forms of housing tenure, including community-led forms of affordable housing. So the talk should be about 40 minutes, and we'll keep 15, 20 minutes for Q&A. If you have any questions, as the talk's going on, please throw them in the chat, and then, I'll group them during the Q&A, so we can try and keep as many interventions as possible, and the questions will be fresh as possible. Yeah, I think that's great. Over to you, Susie.
Hello, everyone, and thanks a lot for the invitation to Tommy. Maybe I'll start by sharing my screen, and then I'll go more into discussing what. It's okay, I found it. Too many windows open. Okay, can you see it? I'll just make it full screen. Okay, great. So yes, my presentation will be about the financial futures of housing from above and from below. And this framing of financial futures, it's also because my role in GeoFin, I joined GeoFin in May, and for the last bit of the project actually is the CRC run by Martin Sokol. And so I'm working on the last tranche of the project, which is called Financial Futures. Building on the analysis of work previously done by members of the team. And so that's my background actually is a lot in research on housing finance and also housing activism, as Tommy had mentioned, and housing policy work as well. But what's most relevant now to this topic is that I had previously done research on the socio-spatial inequalities that are inherent to housing finance, and then building on this experience or building on this knowledge, conceptualizing how there could be a more progressive form of housing finance in Eastern Europe. And so within GeoFin, I'm actually working, or my main task or my main goal as part of the project is to develop 2 papers on these two tranches, which I will develop in this presentation. And the first one being how housing financialization developed after the 2008 crisis in Hungary, and what role the government's measures played in that. And it's particularly interesting because Hungary, well, among some researchers, there has been this discussion whether what the Hungarian government was doing after 2010, whether that can be considered as a process of definancialization. And this is something that I will challenge in the presentation, just to give a bit of a spoiler. But so there's a specificity which makes it interesting. And then the second one is on the possibilities for progressive new forms of housing finance. And especially in the second part, I built quite a lot on my practical experience beyond research experience, because in the past years we have been working a lot on developing new affordable housing forms in Hungary, and specifically housing cooperatives, but and also giving policy recommendations to municipalities. And then within the work on housing cooperatives, there's an Eastern European network called MOBA Housing Network, which we have established, which also aims to become a financial intermediary on a regional scale for new affordable cooperative housing initiatives. And so in the process of developing these models, we very often come up against the financial barriers, and we are also in negotiations with different financial actors that shed light very much on what different forms would be necessary. And so this is the outline of what I will be talking about. The first part, I will give a bit of context to this discussion, and then I will talk about these two facets, like first this from above element, and then how it looks from below if you are trying to develop new affordable housing mechanisms. Yes, so first to start with this contextualization of what is it, well, how I understand the more general process of housing financialization in Eastern Europe, but then I always come back to the Hungarian case because that's what I know in depth, and that's what most of my work has been on until now. So it's very interesting because just last week there was a discussion that really came up strongly within GeoFin, within the GeoFin team, about how do we call this kind of financialization that's happening in Eastern Europe? Do we call it dependent? Do we call it subordinate? Do we call it peripheral, semi-peripheral, uneven financialization? So there's kind of this ongoing discussion actually of what's the best way to frame it. And so the notions of dependent financialization, they are linked, of course, to the tradition of dependency theorists and also to world systems theory in a way. And it operates very much, of course, with these notions of core and periphery. And here, this is, by the way, the terminology that in previous work I was using, like in my PhD or in previous articles. But here, yeah, there's this challenge that the classical dependency theory builds a lot on unequal trade relations, and if you're talking about financial relations, you have to, of course, go beyond this understanding and link it in a coherent way. Then, if you think about subordinate financialization, it's a lot of authors are using rather this terminology recently. And here there's the point of departure is more from the global money hierarchy and linking to these notions of uneven and combined development, at least in the case of Fernandez and Albers, who you all probably know. And here there's an interesting, or I think very important thing to highlight, that there's this dichotomy of export-led growth and financialization and asset price increases, which are traditionally opposed to each other, but that actually in this situation of financialization outside of the economic cores, these are not contradictory to each other anymore, and happen well, go hand in hand actually. And then what's also important, I think, especially in a context of geography, or in the group of geographers, is to link it to the notions or to the literature on uneven development, and to the ideas of how these inequalities are co-constituent and are reinforced over time. So there is this, shifting between these different terminologies, and if you have any feedback on this aspect, that's very appreciated as well. But what I would like to pin down is that beyond the terminology, I think all of these authors, and also in the discussion within GeoFin, we were pretty much agreeing, on the empirical baseline of what we want to talk about, which is this unequal relation and the a broader context of economic dependency and this hierarchical relation between the economic core and economic peripheries. And there's also, this acknowledgement that the global south is different from Eastern Europe, but in the structural patterns there are similarities, and that the question of how housing finance unrolls in a certain economic context, this is very much related to these relations of economic dependency. And I think that's what the main point is around these different terms of dependent financialization or subordinate financialization, is that to see it as a result of the structural processes or the structural inequalities of how capitalism unrolls, how financialization is happening, and that it's not just a parallel process of, well, it's happening differently here and differently there, but that there is this dependent relation. Yeah, I will move on. I was perhaps developing that too long. So in practice, what does this mean in the Eastern European context? On the one hand, and then now I'm going to start focusing down on housing finance. So on the one hand, it means that there's a volatility of finance, and this is really a crucial characteristic of how these housing markets work. There are expectations of much faster and higher returns and less commitment from the financial actors. Like, you don't really have actors who would be committed in the long-term development of financial instruments or of housing products, let's say, in this with this ugly word. And so actually these housing finance tools are integrated into this context of economic dependency. And this volatility then results in volatile housing markets. It's unpredictable for households, it's unpredictable for market actors. And so there's this very strong volatility in the volume of capital that's available on the housing market, but also in what kind of financial mechanisms are available. And then this also creates house price shocks. Like in the past years, you can see that statistically as well. There's this new rollout of mortgages and new housing finance instruments since around 2015 throughout Europe. And it's like Eastern European countries have been experiencing a much steeper house price increase than Western European countries. And Hungary is actually at the top of that hike. And so there's alternation of periods of when capital flows abundantly onto the housing market, and then when it stops abruptly and there's a lack of housing finance. And then of course the government can do things to make the situation better or worse. The Hungarian government usually makes it worse because they step in with these pro-cyclical measures that when anyway there's an abundance of capital on the market, they start pumping more money onto it, and then that's what's happening now. And then of course that creates these asset price bubbles. And so this lack of stability is not good for any of the actors actually. And so my question is whether new forms of housing tenure and new institutions could actually bring more stability. And so I think that's interesting because there's of course the approach from the housing justice aspect that people need housing and they should have access to housing that they can afford. And then there's the other aspect, which is interesting perhaps in making market actors interested or engaged, or the government or political actors interested, is that actually more housing market stability would be beneficial for all actors. And so this is something that I just put here because I was, like I said in the beginning, I was working on household debt quite a lot. And not just mortgage debt, but other kinds, but I will not talk about that part now. But so in these countries, household debt is a very important part of housing financialization, which is also linked to this institutional gap in that we don't have organizations or companies that would be owning and managing rental housing, for example. And so we don't have institutional landlords, to put it more simply. And this means that a lot of the money going on the housing market will be through individual mortgages. And because of this, loans and like household loans, they become a very important part of how financialization actually happens. And so this graph, it just shows, well, these gray bars are the volume of household lending, cost of borrowing, and then this is when quantitative easing begins. This is just a graph that claims that there's a relation between quantitative easing and the expansion of household lending, that actually household lending becomes this sector that absorbs excess liquidity. And then there's the problem, well, or not necessarily a problem, but the situation that there are much stricter lending criteria since the crisis, and also banks are more risk adverse, and so in the end there are less households that they can lend to, but there's still this liquidity that they want to pump on the housing market. And so there's this specific pool of households, like middle class, who can access home ownership, and who are getting easier and easier access to household mortgages. And then the housing that they can acquire, the price of these is going up, and then that has an effect on the whole market. And just one more graph to show how in Eastern Europe household debt is really an important part of how financialization rolls out. Here, this graph is about the year-on-year evolution of outstanding mortgages, so the change, and the yellow bars are Eastern Europe, and you can see that since 2015, Eastern European countries have had the highest year-on-year increase in outstanding mortgages. And yeah, this one is Southern Europe, so that's another, well, there's a bigger volatility there, let's say. Yes, and so actually this focus on household lending, if we go back to before the crisis, this was what was happening, and there was a very direct form to come back to this topic of dependent financialization. There was the institution of forex loans, foreign currency denominated loans, which you all perhaps know about, denominated in euros or in Swiss francs, dispersed in Eastern European countries, but the households have to repay them according to the current value of euros and or Swiss francs, while they have their income in the local currency. And then as a result of the 2008 crisis, a lot of the Eastern European currencies that were not pegged to the euro, they dropped drastically. And so in the end, this led to this whole social and economic crisis, where a lot of households went bankrupt. And in Hungary, this was really a massive, massive crisis. Many households had forex loans. Many of them are still struggling with this debt overhang, let's say. And so this situation post-crisis led to this shifting landscape of how housing financialization rolls out. And I think one very interesting aspect that is often overlooked are debt collector companies, which are large international actors that have, since the 2008 crisis, they have very much increased their activities in Eastern European and Southern European countries. And they kind of spell out the geography of the crisis, I think. Another blind spot is the growth in consumer loans, which are the number of consumer loans is growing much faster than mortgage loans. And there's also a growth in the volume, like in the amount that you can get as a consumer loan. And often households who are not eligible for a mortgage, but still need to solve their housing situation somehow, they will take a large sum consumer loan, which of course has worse conditions than a mortgage. So that's in a nutshell about the context of housing financialization in Eastern Europe. And now I will go on to talk about what the financial future of housing from above, and what the Hungarian government has been doing since 2008. There were very strong government interventions after the 2008 crisis because of this big forex loan crisis. And there were some I will not go into all the things that were done at that time, but it did have the effect, and this is where the claims of definancialization in Hungary come from. It did have the effect of breaking this very direct foreign dependency in terms of housing finance. Or actually, I have a slide that will explain that a bit more. And then since 2015, there's this housing market revival that is well, it's happening everywhere. It's on the market. But in Hungary, it's being spurred very much by the government. They introduced this this very large-scale program of providing subsidies and subsidized loans as well. They go in pair to middle-income families according to the number of children they have. This is a poster for this kind of subsidy plus loan instrument. So it's geared towards middle-class families, and it has this very strong natalist perspective in it as well. And you can even get it if you promise to have children in the future, and then if you don't, then you have to start paying it back. And then beside the subsidy, there are also these very favorable loans that you can have access to, but only if you're married and have children. And then beyond this financial push towards middle-class households, there's also a very big push in the construction industry, and they are supporting new development, new residential developments, but then of course there's nothing done for these new developments to be affordable in any way. So it's actually just and they also introduced this tax benefit for real estate companies if they engage in residential buildings. So my claim is, and I will go into more detail in just a bit, that the financial logic continues to dominate in the sphere of housing, but there has the scope of beneficiaries has been shifted, both on the level of market actors and on the level of households. And so there's this polarized or dualist housing finance system that has developed, which where there are new kind of mortgage loans which are quite safe because they are super regulated since 2008, that can be accessible to social groups who are favored by these government policies, and to have good employment conditions. And then the other financial instruments are left a lot less regulated, and so all of those households who fall out of this narrower circle, they turn to these other kinds of financial instruments, which is one of the reasons of why the growth in personal loans or in consumer lending has been growing very fast. And so this results actually in positioning local elites and domestic companies in housing finance. So there are a number of instruments, such as taking the banking sector into domestic ownership. 90% of the banking sector was in foreign ownership before 2008, and now this is below 50. And there has domestic economic elites have gotten very favorable state subsidized huge loans for buying out the international banks. There has also been regulatory coercion towards international financial institutions, pushing them to sell their shares to domestic actors. There's been a regulatory ban on forex loans. These housing subsidies that I mentioned on the previous slide, they are channeled through banks. So you go to the bank to ask for this housing subsidy, and then of course, in many cases, you can't really leave without also taking a loan. And this is not, set as a rule anywhere, but this is the material interest of the banks, of course. And then in the construction sector and real estate industry, there are these oligopolistic relations and a preference for domestic companies, and not only domestic, but companies who are somehow loyal to the government. And so there has been the domestic economic elites have been positioned in the past years in key unmovable sectors. And of course, housing and real estate are very important in that. And as a prerequisite, the financial industry is also very important. And so this is from a paper. There's another a Hungarian author called David Karas, who has done very, very nice research specifically on how what's going on in terms of financialization in Hungary. and also reacting in part to these arguments on definancialization. And he's been taking a look generally on all kinds of policy interventions in economic spheres, not only housing. And his argument is that there has been a reactive channel that has been trying to, cut certain economic relations or economic dependencies that are economically or politically not favorable for the government. And there's been a proactive channel that has built new financial verticals and new kinds of financialized circuits that would benefit those interest groups that the government wants to benefit. And so here I have just circled in red the ones that are more closely linked to the processes related to housing finance that I was talking about. And so there were all these interventions after the crisis linked to private debt and to retail banking, and especially to the presence of foreign creditors, and the same of reducing forex loans. And the bailouts and debt reconversion of households. And then as a next step, there has been this proactive channel that has strengthened the financial circuits I was previously talking about for households and also for different economic actors. And so just to develop a bit more on these arguments, there's this question of definancialization. And so actually evidence suggests that there isn't this financial freedom fight going on, but strengthening authoritarianism in Hungary and deepening financialization have gone hand in hand. And the financialization has been deepened in a way to strengthen the economic and political position of the government. And it's quite, put together in a quite complex way. And so in the field of housing, you can, if you only look at this very, very direct link of dependency that forex mortgages mean and foreign bank ownership, this link has been severed and has been very much reduced. But at the same time, the other mechanisms that have been introduced have generated this domestic asset price bubble. And it's also the basis for new rentier bargains. And so this creates this new financial vertical that I was talking about, where housing and housing finance play this very important role, actually, because it's on the one hand the way of securing a voter base among the middle class and of strengthening economic elite that is crucial in the economic stability of the government, and at the same time it kind of controls those who do not have access, or those social groups who do not have access to these benefits. And this creates this synergetic feedback loop and within this nationalized form of financialization. And definancialization is only happening in very limited domains where this is the economic interest of the economic elites. And I'm just realizing that I don't have so much time, but I will try to go through this third part quickly on the financial futures of housing from below. And so my argument is, and I will not go into this in detail, that individual mortgages have very important limitations. Basically, that my claim is that mortgages are still not accessible and not affordable to many. And then that's a different argument that even if they would be, I don't think that it's a good solution, since in the long term it increases inequalities. Of course, if there's a housing structure that is only geared towards home ownership, and this is, I think, one of the fundamental problems of Eastern European housing markets, that is so much geared towards individual home ownership and the increase of mortgages. And this is not going to create a solution to the housing problems of large social groups. And so I think some forms of housing finance are very direly missing. And to put it in generic terms, this is patient finance that would be available in long term with low interest rates. and long-term housing purpose funding to organizations and not to individuals. And this is something that I think from Ireland probably seems quite trivial, that nonprofit corporations and housing organizations should have access to long-term cheap finance. But this does not exist at all in Eastern Europe, and I think this is one of the most important bottlenecks for new forms of affordable housing to be able to develop. So of course this would have a social benefit, and then also the more broad housing market stabilizing benefit that I mentioned before. And so just to turn the argument around a little bit, I also think that housing finance could become an enabler for these new housing institutions. And so just to be more specific about it, what I mean by new housing institutions, on the one hand, institutionally owned affordable rental housing, that is housing associations and similar organizations which do not exist in the region. And I think without these kind of organizations, the expansion in volume of affordable housing is not realistic. And the kind of patient finance that would be available to them is a prerequisite for this. And then housing cooperatives are a kind of form that have a historical precedent in the region, and ownership-based cooperatives exist. But this is still not accessible to people who cannot access individual ownership. So this needs to be, expanded to rental-based cooperatives as well. And then just to highlight a few potential financial mechanisms more specifically. On the one hand, there are, of course, the government subsidies and government loan-based instruments, and now also the European loan-based instruments. And another interesting thing to explore, I think, are bottom-up self-managed funds and community financing, which are more like these last two are more unconventional forms of affordable finance. But I think, especially in our context, they are important to explore as well. And I will not talk about government subsidies and government subsidized loans, because I think that is quite straightforward, and that's, well, it would be straightforward. And for it to start happening, there also needs to be a push from below and also from policy experts. And so now to go on to these European instruments, which it's also very relevant now because there's the new financial framework is starting to be rolled out now, and many of it are loan-based instruments, which can be seen as a worse situation or a step back compared to grant-based instruments. But I think that in the field of housing, actually, they can be used quite smartly, because it is the kind of affordable long-term finance that we are looking for. But here there are a number of obstacles for small housing organizations to actually be able to use them. And one of them, which is in Hungary, especially an obstacle, that it's very hard to get around the nation state, because most instruments are channeled through local governments. Then there's the problem of the capacities of housing organizations, which are often small. And there's this catch-22 that they can't become bigger as long as they don't have access to adequate financial instruments, but they don't have access to adequate financial instruments as long as they are small. So this somehow needs to be overcome. Reducing the minimum loan packages and financial intermediaries to be trained about the specifics of housing in Eastern Europe. Then a few words about what I mean by a community managed bottom-up fund. This is an experience that we are developing within MOBA Housing Network, this Eastern European network I had mentioned in the beginning. And this fund, it would be operated on the level of MOBA, and it would acquire finance from different sources that you can see on this side. And then it would give out loans to members and potentially also guarantees. And this is set up already. It's very small at the moment, but this year we will be doing a lot of work to expand it and to attract new investment into it. So we're quite excited about that. And then this issue of community finance. And this is, well, it's an experience that we have in two different Budapest-based organizations. how actually it came out of a necessity, because we wanted to have access to a proper bank loan, but we couldn't. And so we started using community finance, like asking for loans from people in our network. And actually, these are two real estate projects. One is housing, this one that you see as a community space. And then these projects were financed to a very large extent with this kind of direct lending. And in the end, it turned out that this is quite a nice thing, because it's a way to mobilize community through their financial involvement. And it's a way of complement, or well, it kind of acts as equity. And because it is not, well, I will not go into the technical details now, but it can be complemented also with a loan. And it kind of can buffer for this lack of long-term finance, because it can kind of artificially lengthen the loans that you would otherwise have, but it puts a lot of risk on the organization that is taking the loan. And I just have two summarizing slides. One is about then how these bottlenecks should be overcome. And I think all kinds of different actors have a role to play in this. I think the role of the state is what is very often mentioned. And of course, it is inevitable in the field of housing. But I think it's interesting to explore what role market actors could also have. And I think there are a number of things that could be done. And the role of housing organizations, which kind of need to create this pressure from below. And then to come back to the financial aspect, I really think there is a financial innovation needed for more, well, for the housing situation to improve a bit in Eastern Europe. And in practice, this means all these things I was talking about before: longer term loans to be accessible, financing to nonprofit entities, and also to smaller actors. And then there's always this big question of how to scale up beyond pilot projects, because there are quite a lot of very nice pilot projects in different Eastern European countries. But then for these to scale up, I think we really need to build robust institutions and to have secure financial channels that you can count on, that they will be there in 5 years and 10 years as well. And for this, of course, you need an enabling policy environment as well. And just to be a little bit optimistic, I think there might be a potential opportunity in the current moment, because there's this economic instability also linked to COVID and the ensuing economic crisis. And this also reduces, well, it kind of creates a situation where perhaps financial actors are willing to experiment a bit more. They are pushed to, individuals cannot access mortgages that much. They are also kind of pushed to engage perhaps more in these kind of alternative solutions. And of course, the need is always there. And at the same time, there's this big liquidity on financial markets that can perhaps, but maybe this is too naive, but can perhaps be channeled into these kind of more progressive solutions. So thank you. And I will stop sharing so that I can see everyone.
Thanks for that. That was really interesting. If people wanted to write questions into the chat box, I can group them or read them out. And if there's not a ton of questions, then maybe actually people can pose them directly and have more of a conversational thing. But I'm always very struck, particularly I suppose hearing from research from GeoFin, but how like familiar it can sound hearing about these kind of like contextual factors or situations about kind of crises in housing, and sometimes some of the contextual situations, you think of them as being particularly Irish maybe, but you hear about say whether it's particularly maybe in Hungarian situation as you described, where you have the rentier bargain, where you have the solutions being subsidized home ownership targeted at voter bases, and then even like some of the more recent historical factors with kind of domestic ownership of the banking sector, oligopolistic relations in real estate and construction sectors, and and a private rental sector dominated by small landlords. Like those are things that, like, you know, some people would even like characterize as, you know, typically Irish in the housing situation. And so I thought that was very interesting. So maybe to start off, could you maybe elaborate more on what that discourse of definancialization was or is?
Well, I'm a bit, you know, troubled with that because that is not my research. It is mainly linked, well, to other researchers working on Eastern Europe.
Mm. Well, what was the kind of argument, or what was
that? Well, the argument is that that since there were these measures, you know, that of taking over the banking sector after the 2008 crisis and taking it into domestic ownership, and the banning of forex mortgages, and also there were different debt cancellation mechanisms put in place specifically for handling this forex mortgage crisis situation, that these were actually signs of definancialization. And then beyond housing, there were also other measures such as shifting state debt also to domestic lenders, and well, there is this big large-scale household program also where households can invest into government bonds. And so all of these have actually resulted in a shift. But I think that the main difference in our arguments is that it's not, I would not say that this is definancialization. This is like a decoupling of domestic financial processes in certain spheres from these very direct international dependencies and international linkages. But there's still like this very deep process of financialization going on domestically, and also the international dependencies, perhaps in housing finance, they were altered, but in other spheres of the economy, such as the productive sector, I know, automobile industry, not at all. And there's in other sectors of the economy, there's still this very clear international dependency that is still happening. So I think it's not like to claim it to be definancialization is like, you know, reducing financialization to a certain aspect, which is like direct international dependency and finance. And I think it's broader than that.
Rory, do you have a question?
I do. Thanks, Tommy. Thanks, Susie. That was super interesting. So I guess feeding on from Tommy's comment on your answer there, like there's also the striking similarities with Ireland. At one point in your talk, you were like, it may seem kind of a basic assumption, Ireland. I was like, no, we don't have that here. This is not a Switzerland or Austria or something. But and also kind of wary of kind of the othering of Hungary that we see in Irish media discourse, as well as I think Western European discussion. I mean, one of my question concerns is the nature of the Hungarian state, specifically, and its peculiar structure, let's say, both in as far as the state is a kind of source of the problems, which you're pointing to, but also its necessity, as you pointed to some degree, as being an agent in making solutions. So I mean, and you know, when you're talking about this, the nature of definancialization, and it's kind of possibly kind of mythic, it's like rather a refinancialization or respatialization of financialization, which is very in keeping, it seems to me, with the kind of illiberal democracy of the Hungarian administration, in this kind of sense of it's kind of a nationalization of financialization. So you kind of have an anti-globalist kind of agenda put into the sphere of finance, but you have a pro-capitalist and authoritarian version of what supporting the nation means. So I guess like it's more of a rather open question, but how much this, so rather than the kind of similarities, which are very strong to the Irish case, in fact, actually, I'm sure to other contexts, what about the specificity of the nature of the Hungarian state under Urban, and how is this, obviously it's mapping very neatly against the kind of post-crisis phase, and how much do you find this is an obstacle in terms of those solutions that you were looking at, those that involve the kind of state funding finances or funding mechanisms? Can we have kind of housing change within this state structure, or does there need to be a change to the state structure kind of before or coterminous, and how you know, if you get what I'm getting at there? It's quite a large question, I guess.
Yes, I will try to take it by bits. Thanks for that. So first, the similarities to Ireland, I'm actually very glad you pointed that out, because I think that Ireland can also be seen as a semi-peripheral economy in Europe in many ways. And actually, like previously, when I was looking at statistical data on a European scale, I would put, and I'm doing these country groupings of like core and semi-periphery, and I would put Ireland in the peripheral group, or actually it was this outlier always. And then I would have Eastern Europe and Southern Europe plus Ireland, which kind of looks weird, but it was because of this kind of structural similarity, and also the kind of the nature of the housing boom before the crisis was very similar to that in Southern Europe. So yeah, thanks a lot for pointing that out, and I completely agree. Yeah, and then what's the similarity and what's the specificity of the Hungarian context as compared to that? Well, I really think it's useful to think about it as these different facets of refinancialization and definancialization. And what I think is specific is in Hungary is that since 2010, the government has managed to take over many sectors of the state and of the economy. And through this, they have really achieved like a very, in a way, very coordinated intervention in different spheres and different sectors. And if you don't have a government that has super majority in the parliament, then it's much more difficult to do these things. And Fidesz has over 2/3 in the past 10 years. And this has allowed them to intervene in a number of segments of the state that would have otherwise not been possible. And I think in order to put together this, these different interventions that then kind of support each other, it's necessary to have this kind of regulatory power, actually. And that's maybe a specificity, because then actually I think in the broader picture it's not so particular. And now with the COVID crisis, like a few years ago, the monetary policy of Hungary was coined very unorthodox, but now other central banks are starting to introduce very similar measures. So I think it's not outstanding so much, or like the different government measures to support the home ownership of middle-class families. That's also something that a huge number of governments are doing. And maybe not, not in such an absurd way that it's according to the number of children you have, but still there are many countries where you have these kind of policies. So maybe the specificity is just that it's being rolled out, in a very aggressive way, and without really consideration for any other kind of social actors who could influence the way these are being developed. And so the possibility of change, I think there are some parts of it which can be, developed maybe in parallel. For example, with our cooperative housing initiatives, we have these discussions with some market actors and looking at how perhaps there could be, and there's an increasing interest in some kind of socially and environmentally sustainable investment goals, which I know are often very, slippery ground, but still, I think here there are some minor possibilities in the sphere of housing of like doing things without the government. Also, local municipalities present some kind of possibility, and there are many oppositional municipalities in Hungary, like the Budapest municipality, and most of the districts are also governed by more socially sensitive political forces, and we have quite a few cooperations on different levels, but municipalities at the same time have very, very limited financial resources, and so in the end, to achieve big changes, I think there has to be some kind of shift on the governmental level. But in the meantime, you can develop models that work, and you can build up institutions, and you can start collaborations with European actors, with market actors, with municipalities, with other housing organizations, and that kind of starts to build a web that can change the narrative, for example, and create possibilities.
Thanks.
And you mentioned kind of the entry into the housing sector, maybe of kind of debt collector funds. Is that fair to call them?
Debt collector funds,
Or
companies, yeah.
Companies, yeah. And so it was like my question, I suppose, is you know, comparatively again with Ireland, maybe that there has been the entry in the last couple of years, maybe since 2018, of, you know, real estate investment trusts, and this is kind of the foothold for, you know, corporate landlords into the Irish rental sector particularly. And I guess my question is, so that, you know, colloquially referred to as vulture funds, well, so that there was kind of the purchasing of distressed assets, you know, and which was part of this this phase from 2017, 2018, where real estate investment trusts then followed on, maybe. So it's, you know, the real estate investment trusts aren't necessarily what you call the vulture funds of purchasing distressed assets and then selling them on, but you know, my question is, like, do you see I
think Susie disappeared.
Oh, I think we might have lost Susie there.
Huh. How do we get her back? Look, she'd had enough of us.
Hi, sorry, I dropped out, but
sorry. So yeah, my question briefly was about you know, is there potential, or is from the development of debt collector companies into something more financialized, or is it purely just, you know, eviction companies?
Well, it's more the latter. I think it could be, you know, interesting to, this is like people usually think it's a very strange idea, but to engage in conversation with them, I think. Well, I don't think, like, in the short term, no, there's no possibility, because actually they acquire these debts, but then they don't want to manage housing. Like, and we come back to this problem of the lack of any kind of actor that would be willing and capable to manage housing in the long term. And so actually these debt collector companies as well, they could have the potential, because they get a lot of properties actually in their hands, and there would be the possibility of them, I don't know, creating a real estate company. Actually, the biggest Hungarian bank did this. They had their own like in-house debt collector company, and then they created this in-house real estate company. But even there, they don't manage properties in the long term. It's only meant for reselling quite quickly. So no, the short answer is no, they don't do this. I think there could be such a possibility, and it would be interesting to find such an actor potentially. But it's not in their mode of functioning.
We're nearly at the hour. I guess if there's no more questions, I would actually like to, if you know, push it to 5 past, maybe quickly ask you about your experience with AVM, Veros Mindenki, the City is for All, and kind of what that group is or has been or is about, and then also your experience with the
Peripheria Center.
Exactly, yes, please.
Yes. Yes, so actually we've met with Tommy, not at Trinity, but through housing activist groups several years back. And well, I was engaged for 8 or 9 years in this group called City is for All in Budapest, and which is well, a rather classical housing activist group, stepping up against evictions and pushing for policy change. And I'm no longer active in this since 2017, more or less. But well, the interesting or what was novel in the Hungarian context when we started this group in 2009 was to organize those affected by the housing crisis. And then, of course, the difficulty is that there are very different social groups affected by the housing crisis, and how do you build alliances between them? Or that's something that I think the whole like broadly defined housing movement in Hungary is struggling with, that there are very few actors, and in places where the movement aspect is also more developed. I know in Germany, for instance, you have specific housing movement groups for every kind of social group that has a housing problem, and then everyone can find their own community, and then they form an alliance and push together for housing policy changes. And so here you have a housing movement that kind of tries to take on a number of different roles, and then this makes everyday organizing difficult. But I think the fact that there has been a massive change around the issue of housing in Hungary in the past 10 years, and by now it's really an acknowledged thing that there is a housing crisis, that there's something should be done about this, and that oppositional parties, that we will have elections in April, and none of the oppositional parties think that they can afford not to talk about the housing crisis, and they are now consulting us on a regular basis, actually. And so this is the result, I think, very much of the like more than 10-year activism of this housing group. And then also, of course, of the changing context that in the past years, housing has become a problem for social groups for whom before it was not. And I think this is also a global phenomenon. And this well, globally, housing movements have become more important in the past years, and their voices are becoming heard a lot more because, well, you know, to be ironic, I think it's also because the middle class is starting to feel the housing crisis on its own skin. And then, of course, the middle class is more vocal politically. So that's what's going on now. And, or, well, this is the maybe story of this group that Tommy was asking about very, very briefly. And then Periferia Policy and Research Center is an organization that we founded with a few people with whom we have been working together for a long time. It's a critically engaged, small, well, let's say think tank, but without the bad connotations. We do research, we do policy work, and we do like support to social movements. And now, for example, next year we are planning to have a joint project with this aforementioned housing activist group around the issue of housing debt, and to do some kind of action research. And we also reproduce a lot of materials that are not academic, but, you know, kind of aim to well, talk about complicated things in an understandable way, talk about depth, talk about financialization in an accessible way. So that's what we do there. And I will type our website in the chat and you can check it out if you want. And I will also type the other one, the name of the housing activist group is that. And this is their website. They are hosted by one of the, so yeah, I don't know if you want me to go into anything more in detail, Tommy.
Well, it's 2:05 now, so I guess people have to head off. So I'll just say thanks a million for coming to speak to us. And I'll quickly say that on January 26th, we joined for the next seminar by Professor Kate Spencer, Professor of Environmental Geochemistry at Queen Mary University London. So that'll be the next lunchtime seminar. But yeah, thanks everyone for coming.
Thank you very much for the invitation.
Thank you.
Bye-bye, and nice holidays.
You too. Thanks a million. I'll stop the recording.